Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
$29.94. That was the close for DraftKings, January 29th, 2026. And if you've been watching the tape like I have, you know exactly what that number means. It means a month-to-date drop of 13.31%. It means we have a stock that's just completely lost its footing, trading consistently below that really key 200-day moving average of 37.55. And if you just rewind a few days to January 23rd, we saw what looked like, a capitulation, a 5.22% fall in one session on, over 17 million shares of volume. That is a lot of selling.
It was ugly. I mean, there's no other way to put it. When you slice through the 200-day on that kind of volume, the algos, they flip from buy the dip to sell any rip you can get.
It was volatile, absolutely. But that volatility, it brings us to the one urgent question we have to debate today. Is this technical breakdown a massive buying opportunity before they finally turn profitable? Or is it a signal that the entire business model is, under some kind of existential threat? I'm arguing that the operational expansion, I'm talking about Missouri, the ESPN deal, makes this a strategic entry point. The market is staring at the floor. I'm looking up at the ceiling.
And I see it completely differently. I look at that exact same price action. I see the insider selling. I see the rise of these prediction markets like Polymarket. And I don't see a discount. I see a structural repricing of the stock. I think the market is signaling that the growth story has a hard ceiling we didn't see before. And frankly, the smart money is getting out before everyone else realizes the party's over.
I see why you'd think that. But let me offer a different thesis. We're literally witnessing DraftKings transition from that growth at all costs machine, burning cash to get customers, into a sustainable, profitable engine. This isn't the DraftKings of 2021, where they'd spend $1 to make 50 cents. I mean, look at the Q3 2025 performance. Revenue growth didn't just meet expectations, it blew past them. They raised the full-year guidance, they expanded the share buyback program. That is management telling the market in no uncertain terms that they have confidence in their cash flow.
Well, confidence is easy to talk about in a press release. Execution is a lot harder when the tide goes out. And let's be honest, sometimes a buyback is just a mask for not having any better ideas for your capital.
But the execution is already happening. Look at the catalyst right in front of us. February 12th, 2026, we get Q4 earnings. And the consensus, it's projecting an EPS, an earnings per share, of 45 cents. That is a 260% increase year over year. That's huge. Then, March 2nd, we have Investor Day. And you have new markets. Missouri launched December 1st, 2025. That's 29 states now. We're talking about a company with over 30% market share in North America with more than 20 million active users. My thesis is that this sell-off is just completely disconnected from the fundamental reality of a company that's about to start printing money.
I'm sorry, but I just don't buy that connection between those past metrics and the future price. The market is a forward-looking machine, and right now it's looking at DraftKings and it is blinking. You mentioned the price, but let's talk about the conviction or lack thereof. On January 29th, pre-market activity was just anemic. It settled at a one-year decline of 28.54%. The technicals are screaming, get out. The relative strength index, the RSI, is sitting at 33.64.
An RSI at 33 suggests it's oversold. I mean, that's usually a setup for a bounce.
Let me clarify why that number is so important. The RSI, it measures the speed and change of price moves. And sure, anything below 30 is technically oversold. But hovering in the low 30s just means weakness is creating more weakness. It means buyers aren't stepping up, even at these prices. And then look at the MACD, the moving average convergence divergence. It's way below the signal line. There is zero upward momentum. But my bear case isn't just about lines on a chart. It's about who is selling. The insiders are liquidating. They're not buying this dip you seem so excited about. And structurally, the whole industry's potential is getting squeezed by these low-margin prediction markets. The moat just isn't as wide as we all thought.
That's an interesting point, but I'd frame the valuation piece differently. We have to talk about how DraftKings is priced against its peers, because I think this whole premium argument is being misunderstood. Right now, DraftKings trades at a forward PE of, 23.28? The industry average is closer to 17.39.
Exactly. So you are paying a premium for a stock that's down almost 30% in a year. That feels expensive.
But you're paying for quality. You're paying for growth. You have to look at the PEG ratio, the price earnings to growth. DraftKings is sitting at 0.46. I mean, in investing, anything under 1.0 is usually considered undervalued compared to its future growth. You cannot compare DraftKings to legacy dinosaurs like MGM or Caesars. MGM's market cap is $9.17 billion, Caesars is $4.65 billion. They are anchored by physical buildings, debt, unions, massive overhead. DraftKings is a pure digital play. The scalability of digital just warrants a higher multiple than a company paying for air conditioning in a casino. The market is wrong here.
Okay, but I'm not comparing them to Caesars. I get the difference between a hotel and an app. I'm comparing them to the actual market leader. Let's look at Flutter Entertainment, FanDuel's parent company. Flutter has a market cap of $28.94 billion. That's almost double DraftKings' $14.99 billion. And yet, Flutter trades at a lower PE of 18.50.
Well, Flutter is a mature global company. It's going to trade at a conglomerate discount because it has slower moving parts in, the UK and Australia.
I'm not convinced, because that ignores the ecosystem strategy DraftKings has built, which is fundamentally different from Flutter. And that brings us to the partnerships. The deal with Disney to integrate with ESPN. That is a game changer. It went into effect December 1st, 2025. DraftKings is now the exclusive odds provider. We've seen these media deals fail spectacularly before. I mean, remember the ESPN and Penn Entertainment debacle? That was a $2 billion mistake. Slapping a logo on a TV screen doesn't just print money.
But this is different. It's about the depth of the integration. We're not talking about a logo. We are talking about reducing friction. A user is on the ESPN app, checking news on a trade, an injury, whatever, and they can place a bet right there from that screen without switching apps. That reduction in friction is the holy grail of conversion. If you remove that one step of closing one app and opening another, your conversion rate just skyrockets. Plus, DraftKings isn't ignoring that prediction market threat you mentioned. They launched DraftKings predictions on December 19th, 2025. They're trying to capture that demand inside their own ecosystem. And don't forget the Railbird Technologies acquisition.
The Railbird deal just feels like an admission that they were behind the curve.
No, it's turning a rival into a partner. Railbird allows DraftKings to use Polymarket as a clearinghouse, so they're leveraging this decentralized tech to power a regulated, seamless consumer product. They're basically co-opting the disruption. They get the liquidity of a prediction market with the user interface and regulatory safety of DraftKings.
That is a compelling story. But have you thought about the economics of the VIG? Because that's the killer here. It isn't about the tech, it's about the price. Prediction markets like Polymarket or Kalshi, they operate on spreads of 1% to 2%. That's their margin. DraftKings and all the traditional sports books, they rely on 5 to 10% juice, the vigorish. That's how they pay for all the ads and the promos.
But the casual bettor doesn't even notice the VIG. They care about the interface, the brand, the liquidity. They want to place a bet on the Chiefs to win. They are not sitting there calculating the implied probability spread to the 10th decimal.
The casuals might not, but the high-volume bettors do. The whales absolutely do. And we're seeing them migrate. Look at the correlation. In January, Polymarket volume surged to $674 million on Super Bowl contracts alone. And what did DraftKings stock do during that same period? It got weaker. There is an inverse correlation developing. These prediction markets are seen as truth engines with better price discovery because they're peer-to-peer. DraftKings is trying to launch a copycat, sure, but if they try to charge 10% VIG on a product the market prices at 1%, they will fail. You can't brand your way out of bad pricing.
The regulatory moat matters, though. Polymarket has hurdles. DraftKings has 29 states and the blessing of the NFL. But let's shift to who's actually holding this stock, because the sentiment analysis paints a very complicated picture.
It certainly does.
If you look at institutional ownership, it is incredibly high, around 85%. These are not day traders. These are the giants. Vanguard, for example, increased their position by 3.1% in late January. they now hold over 44 million shares. I mean, that is a vote of confidence from some of the smartest money in the room.
Or it's just passive index fund accumulation. It has to be there.
It is still capital commitment. And look at the short interest. We're at 14.36% of the float. The days to cover is at 3.7, and for anyone listening, days to cover is crucial. It's how many days of average trading volume it would take for all the shorts to buy back their shares. Anything over 3 is the danger zone for shorts. If that February 12th earnings report is even a little better than the whisper number, we could see a violent short squeeze. The powder keg is there. It's just too crowded of a short.
And I'll take the other side of that smart money argument. You point to Vanguard, I'll point to the people who actually run the company. The insider activity is a giant red flag. In the last 3 months, we've had 20 insider sales and only 2 buys.
Come on. Executives sell for tax planning, for diversification. It's all standard 10b5-1 plans.
This is aggressive selling at 52-week lows. R. Stanton Dodge, the chief legal officer, he exercised options and sold heavily in January 2026. He was selling between $31 and $32. Why not hold if Q4 is going to be so amazing? And the co-founder, Matthew Kalish, sold around $50 million worth in December. When the founders and the lawyers are cashing out while the stock is down 28% for the year, that is not tax planning. That is a lack of faith.
They're diversifying massive personal fortunes. It doesn't mean the company isn't succeeding operationally.
It completely negates the value argument. And what about the dark pools? The off-exchange short volume is consistently over 50%. On January 26th, the ratio was 50.02%. That suggests institutions, maybe the ones not in those Vanguard filings, are quietly betting against the stock, or at least hedging very aggressively. There's a shadow sentiment here that just completely contradicts the public bull case.
Dark pool data can be noisy, but let's look at the broader picture. We have a company forecasting 64 cents EPS for fiscal year 2026. They are moving from burning cash to generating it. The market is pricing them like they're going to burn cash forever. That's the disconnect.
Or the market is pricing in that 64 cents might be the peak, right before margins get compressed by the prediction market threat we just talked about.
I see why you think that, but the regulatory environment protects those margins. DraftKings Predictions is a regulated product. They can offer security and integration that some decentralized platform cannot. The average NFL fan wants to bet on the game while watching ESPN, not figure out how to get USDC onto a crypto exchange.
And that gap is closing every single day. Crypto user interfaces are getting better. And frankly, the truth engine aspect of prediction markets is really powerful. When you see Flutter and DraftKings stock falling while prediction volume is rising, it suggests the market believes the future of wagering is peer-to-peer, not peer-to-house.
That's a long-term existential debate. For the next 12 months, which is what investors care about, the ESPN deal and the Missouri launch are tangible revenue drivers. That volume we saw, the 17 million shares, it looks like capitulation. And capitulation is usually the bottom.
It's only the bottom if the news flow gets better. If the Q4 earnings on February 12th show any weakness in customer acquisition costs, or if retention rates are dropping because of the competition, that $29.94 price tag is going to look very, very expensive.
To summarize, I believe the market is overreacting to short-term noise. The shift to positive earnings is the hardest hurdle for a growth stock to clear, and DraftKings is doing it now. With ESPN acting as a massive customer funnel and their own regulated products providing a defense, this company is positioned for a major rebound.
And I'll summarize by saying that the combination of broken technicals and insider exodus and a disruptive technology undercutting your core pricing model, that is a trifecta of bearish signals. I think revenue growth is masking a degradation in the quality of that revenue. The 28% decline isn't a discount, it's a warning label.
Well, we won't have to wait long to see. Both the February 12th earnings and the March 2nd Investor Day are the critical prove-it moments. Those dates are going to determine if this stock reclaims its moving averages or falls further into discovery.
Agreed. It is definitely going to be a volatile month.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this and leave your comments below. See ya.